Hello everyone and welcome to my channel, The Smart Investor. So what is it that we're attempting to do here? What we're going to attempt to do on a daily basis is to understand what the market is telling you. This channel is about educating you, okay? I want to educate you. I am not about making recommendation, prediction. No, it's all about understanding. You need to understand. You cannot go and try to pick up prediction from this one, recommendation from that one, because you don't know their personal situation. You don't know what the end goal is for them. They may have a huge diversified portfolio of 50 stocks and they say, hey, buy more Nvidia. Why not? But if that's the only position that you own, it's a huge amount of risk for you. So you have to understand the context. You could listen to the recommendation, you could listen to the prediction, but you got to be careful. It's not just picking one stock and then running with it. How do you know what they have? How do you know what they look? How do you know what they have also in their portfolio? How do you know their risk situation? Because that's the key, right? When they're making a recommendation, they say buy this stock. They're just looking at the stock on its own. It's going to go up 50%, it's going to have 60%, it's going to have 100%. Sure, it makes sense. But you also need to take in consideration the risk. You need to take it, and in their case, they may have a bunch of other stocks, or they may understand the stock very well. So for them, it doesn't behoove them to not recommend the stock because it fits in their portfolio for what they want to do. But again, this is my major pet peeve about this market, is that there's a heavy focus on returns, not so much risk. So that's the first thing. The second thing I want to educate you about, it's not about predicting the market. Is it going to go up? Is it going to go down? Is the Fed going to do this? Is the Fed going to do that? It's about taking advantage of it. I'm not saying you don't care. I'm not saying, oh, I don't care what they're going to do. No. You care. But you need to know how to take advantage of the situation. That is what I'm here to show you. Okay? Also, when you're buying, you want to buy when everyone is selling. I'm always saying that, and my subscribers, and especially my Patreon subscribers, are telling me, so when the market is up, does it mean I should sell? And when the market is down, does it mean I should buy? No. When I say buy when everyone is selling, I mean everyone, right? So if the market is up a little bit, is everyone buying? Probably not. Is everyone buying if it's doing that? Certainly. And if it's going like that, is everyone selling, right? So so in concept, it is you buy when everyone is selling, meaning that you really, like, in terms of selling, you're like way down, right? And you're looking for opportunities. So make sure that everyone has sold and then you buy. Everyone has bought, then you sell. That's how you should see it. So again, education is key. You need to understand these ideas, right? Also, you need to understand who the players are. Who are they? What are they recommending? Why are they talking? What's in it for them? Keep that in mind all the time. Okay? And also, it is not about what is really happening. It's about what they think is happening. What does that mean? Well, it doesn't matter if we're in a recession. If everyone thinks that we're not, and everyone is buying, then the market is going to go up. And if you bought, and if you're not buying with everyone else, then you're losing an opportunity. Even though we might be in a recession. It doesn't matter where we are. The point is what's happening, what is a perception, what is going on with everyone else. So that's why it's important to understand what is they think is happening, not what's actually happening. As far as a recession is concerned, you don't know what's going on now. You don't. I could tell you that some of my students, for example, are having difficulties finding jobs. So it feels a bit tight to me, but I don't know. I mean, I'm only speaking to, 10, 20 students. I'm not speaking to the entire population. So maybe I'm in the wrong category and these guys are pretty smart and maybe they're looking for jobs in an area in finance that is not offering. So who knows? The point is, you need to understand the environment. Okay, so enough of this. So what's going on out there? Let's find out what Ed Yardeni is saying. Ed Yardeni, I met Ed when he was at the DB in the days Back in the days, he was at Deutsche Bank. And I always thought that he made lots of sense. He was always making some interesting recommendations. He moved around quite a bit. Now he's got his own firm. So let's listen to what he said.
Expectations are 25 to 50 basis points of the September meeting. I think there's still expectations that maybe we'll even have 100 basis points between now and year end. I think it's going to be 25 basis points at the September meeting, and I think it's going to be one and done. Economy's just doing too well. I know that people got freaked out by the last employment report, but I think a lot of that was weather. And some of the other indicators that came out kind of confirmed that, like housing starts, single-family housing starts took a dive in the South. So if I'm correct about that, they're going to get some indicators before the September FOMC meeting that suggests the economy is alive and well and the labor market's doing well and that inflation is continuing to moderate. So I think 25 basis points is enough.
Basically, he's looking at 25 basis points in September, and he's basically the economy is fine and well, and we don't have a consumer recession. What does that mean, a consumer recession? Well, you need to understand that in the US, we are an economy that is driven by the consumer. Right? Consumer goes, we go. We might have, and we probably have, a recession as far as real estate is concerned. Maybe in some industrial sectors. But overall, as far as the consumer is concerned, he or she is still spending. Okay? So then they have the money to spend it. So his view is, well, the Fed is basically going to come to September. He's going to say, look, and look at my previous video on that. He's going to say, look, it's not too bad. Look what we have. We got some growth. I've seen it. I've told you before. Unemployment's not so bad. We are slowing down, but no need to make a big deal out of this. Just tighten a little bit and we're done. Great. What if he's wrong and you're only tightening 25 bips when you should have been squeezing the hell out of this thing way before? It might be too late to stop what's coming, which is doom. Keep in mind, historically, the Fed has not managed well the coordination of the rate decrease and keeping us out of. Don't just think, well, we just tighten and no. They've been raising rates 9 times historically in a very short amount of time, and this thing takes time to hold, but once it's hold, it's gonna hit, according to some people, it's gonna be pretty bad. According to him, and Ed knows what he's talking about most of the time, making a big deal, because obviously if you think this and you think this thing is gonna collapse, then what do? Well, you protect your portfolio, you sell your position, and you miss on what's happening right now, which is pretty good. Look what's happening to the market recently. I will show you what's happening to my portfolio, and there's some doozies in there. Or you could be looking at what Tom Lee is saying. Tom Lee obviously paid for by CNBC, and he's got his own shop as well. Don't know Tom as well, but basically what Tom is saying, it's going to be 100 basis points. So he's seeing several cuts by the Fed.
How many cuts do you think we get this year?
I'm looking at consensus, which is somewhere between 4 and 5.
Before the end of the year?
Yes.
So about 100 basis points?
I think that's right, but it depends on where inflation prints the next couple months. But our base case is that we're on a glide path towards 2%. That's better than consensus. So I think 4 to 5 still makes sense.
Obviously, what he's saying is, cut down as soon as you can. Because you want to slow this thing down. You don't want to slow the economy to a halt, so you want to pick up activities again. Who's right? Who's wrong? That's the question. No, of course, if we keep tightening and we're on the way down, then this is certainly going to help, right? Because it's going to prevent the economy from collapsing. But if we're not on our way down, as per Yardeni, and you keep cutting rates, what do you think is going to happen? People are going to be jumping all over the stocks, and you're going to have this exuberance in this market. It's going to explode and go in different ways. Remember what happened in the past, right? When you cut rates a lot, 2008, stock market went up, right? After 2008, we did a fantastic. And then we got hit with later on with a couple of crashes here and there. So you got to be very careful as well. Of course, if you believe that theory, then with tightening of rates, that is very beneficial to small stocks. Why? Because small stocks do very well with tight rate, because small companies need financing to keep going. So obviously, the cheaper the financing, the better off they're going to be, and the more they're going to be able to benefit, because it's going to be cheap for them to get financing and grow faster. So you want tighter rates and great small stocks. So here you have it, folks. Where we're going to be, you need to decide. You need to think. Okay. So at the end of the day, we are focusing heavily on the equity market. And that's okay. I mean, it's easy understood. Things go up, things go down. You know what Apple does. You know what Hershey does, right? It's easy to recommend, and they're focusing you on the return. Like $10 is more than $5. 50% is more than 40%. It's easy to understand. But I would like to teach you something today. I would like you to take a look a little bit closer at what's going on in the credit markets. Specifically, let's take a look at what's happening to the credit default swap market. Why? Well, because it gives you a feel for how the economy is doing, how traders look at the US as a credit, as a big company. Because remember, in the back of the room, way behind, we still have $35 trillion hanging on us, waiting, creeping, sneaking, lurking. At some point, someone is going to say, no more, right? We have 35 trillion. Before you know it, we're going to be at 57 trillion. So one way to figure out, and this is a trick, one way to figure out if the credit markets are concerned about the US is to look at the credit default swaps. And I'm happy to say, as you could see with 32 basis points, and you could see that the chart is pretty tight, meaning that, it's basically a cost of, it's like insuring the US market. So as that spread drops and drops, I mean that the risk is dropping. And as you can see right now, we are at 32 basis points. When you look at the past 5 years, though, since 22, we have been going up from 10 basis points to this. There's been, some increase in the risk of the US. Now, I don't know if you remember, but there is a chart that I'd shown you about when did we start having issues placing the debt? I know this is complicated, I guess, but you need, this is part of the education, right? You need to understand what's happening. So you need to see who the players and what are the requirements. Not just about, let's buy NVIDIA and retire NVIDIA. This is a little more complicated than that, right? This is about you understanding what's happening. And for you to understand what's happening, you need to understand what's happening to the credit default swap market. And right now, the credit default swap market tells me that in 22, it would cost me about 5 basis points on the 5-year. It would cost me 5 basis points to insure the US. Now it is costing me 32. What it means, I can't tell you. All I could say is in 2008, it used to cost 87 basis points. And that 32 bips is the highest it's been, since the peak that we had in 2023 and sometime in 2012. And so 32 basis points is a bit high, I hate to tell you. It's getting a little bit expensive, so you need to worry about that a little bit. Not for Monday morning, but keep that in the back of your mind, okay? So, what's going on in our portfolio? And that's the fun part. If I take a look at my portfolio, as you could see, on my Tesla position, because the market has been doing well, my November 24 Tesla call is up 64%, and it was up like 80% not too long ago. Over the past 5 days, 64%. What am I doing? Well, what I'm doing basically is I'm riding this thing, right? I don't know how long it's going to last, quite frankly. I don't know what the Fed is going to do, right? I know they're gonna tighten the rate. They're gonna lower the rates by 25 basis points, but they're gonna do 25, 50, 75, 100. I don't think so. Maybe not, right? So I don't want to miss the boat. How do you not miss the boat? Well, you could buy a great stock, but between now and then, I don't know, if I buy a great small stock and guess what? They decide to lower rates only once, people are going to run away from the Russell 2000. How is the Russell 2000 compared to the right now? Let me take a look at it. But I think right now the Russell 2000 is down minus 1%, and the S&P is down minus 0.6%. So I don't know, it feels like there's a disconnect between the small stocks and the S&P. At one point they were moving together. Now the S&P is beating again the small stocks. What it means, maybe the markets say, you know what, we're probably not going to see such tight rates after all. And you know what, it makes sense because the market probably thinks that, we're not going to have a recession, so there's no need to lower rates that much, which means we don't need to worry too much about. That means that the small stocks are not going to benefit. Remember, small stocks benefit when rates have been reduced a lot, and maybe we don't get so much reduction because we don't have a recession. No need to lower that much. Therefore, no need to worry too much about small stocks. So Tesla is doing great. Now, speaking of, well, it's not a small stock, okay? But if you take a look at my portfolio and you take a look at this stock, take a look what's happening to my friend Fabrinet. 20% in one day. Didn't I tell you? I've been holding this stock for 2 years. It's not disappointing. Why? 2 hours ago, earnings came out. Fabrinet reported earnings per share estimate, so they beat and figure increased 29%. The company is in optical communication. The datacom segment was a significant driver of revenue growth, particularly product related to 800 gigs. Datacom revenue surged 63%. The company is doing great. The company is doing great. So here you have it, folks. On one end, I am able to pick a nice stock, Fabrinet, right? It's doing great on its own. I mean, it's not a small cap, but it's not Nvidia either, right? Fabrinet is doing great. The other end is I am able to benefit in the short run, just because I'm wrong, right? And the market starts heading south soon. I'm doing well with my Tesla position. It was almost between 60 and 80% in 5 days. And I am also firming up my opinion as to what's going to happen with the Fed. It's either 25 bips or B, it's like 100 bips over several quarters. You have to watch it. You need to understand. But at the end of the day, please try to stay away from recommendation and prediction and focusing more on what's understanding. It's a very exciting. You can make lots of money in this, but you need to make sure you know where it is that the market is heading, because the market could be heading anywhere. Now, what's actually going to drive all these people to decide? It's almost impossible. Imagine there's almost 250,000 people thinking about this stuff like I'm telling you now at the same time, right? But yet you need to be invested. Yet you need to participate in this action, because otherwise you're losing the opportunity, for example, to make 50, 80% in 5 days on Tesla. Don't wind the position. Wait, come back in later on. Play the volatility. But right now, this is what's happening. Right now, this is what's happening. We're going up because we're expecting rates to go up. We are going up because we don't expect that many rate cuts. We're going up because we don't think that we are in a recession, or at least not something really bad, at least not right now. And we're going up. And therefore, we don't look at too much as the small stocks, as the small caps. But be careful, because as you're going up, your valuation is going up. Your P ratio is going up. I mean, P ratio right now is almost 35, 36, 37. That is pretty high. And remember, my credit default swap, which represents the amount of insurance I am willing to insure the U.S. as a country, is going up. This is not Florida insurance, but it's going up. So do you want to be the one that's buying when everyone, because right now everyone is buying. That's why the stock is up. I mean, that's what the market is up. Are you going to be the one that is willing to start selling, hedging as we're going up, right? Don't do it after, like on August 5th when it goes drop by 1,000. No, I'm getting out of the market. It's too late. You need to do what Warren Buffett did, which is get out of the market before it drops. But this is nuts, right? I mean, you're trying to predict literally what everyone is going to be doing, and everyone is predicting what everyone else is going to be doing. So you got a room full of people screaming at each other. You can't figure out what's going on. So what's the solution? Well, they tell you, you know what? Stay away from all this. Buy your index fund and just let it ride. Yeah, if you want 10% a year. And don't forget, you're not buying the index. You're buying 7 stocks, right? And you could find yourself in 2000 when the market collapsed and you lost 50% of your money and it took 15 years to get it back. Sure, buy the index, stay in the market, stay invested, fill my coffer to be able to buy my stocks or my portfolio because I get paid on the amount of money is in my portfolio. That's the dilemma that you have. Well, let me stay away. Well, you stay away and you're leaving money on the table. Well, let me go in. Well, if you go in, you may still leave money on the table because you're buying something you don't understand. And that's the reason why you kind of have to get into this market. You have to understand. But then what do you do? Well, this is why I hope you come to my channel. You follow me and you like what I do. So at least you have an opinion. It gets you thinking as to what's happening. I'm here to explain, like I explain to my students all the time, what's going on. And, it's like you're driving a car. You can't just throw yourself in a car you never seen and say, okay, go. No, you got to learn how to drive. Some people will have accidents. Some people will not have any accidents. Some people will go fast. Some people will go slow. But at least you are moving. Because you say, well, I don't want to drive. Well, you're missing out on a lot of fun and a bunch of opportunities. And remember, you need to take advantage of any other opportunity. Okay? So let me leave you with these words. Watch what's happening over the next couple of weeks. It's very important. Look at it, understand it, follow it, fear it, like it. But whatever happens, stay on it.